Welcome back. Today we're going to jump into chapter 22. It's called Performance Measurement and Responsibility Accounting. So you're going to see a lot of familiar material, and hopefully this will be a logical chapter for you and not too much of a strain. So let's jump on in. We have several concepts. We're going to start talking about what transfer pricing is and how to set those transfer prices. And that comes a little bit later in the presentation. And then how do we allocate joint costs? And we're going to talk about what joint costs are across different reading appendix, but it's not that, it's products, how we're going to allocate those joint costs across products. I guess I haven't had enough coffee yet. Okay, so those are the concepts. The procedures, we're going to prepare reports that show what costs we can actually control. That's what we're worried about. We're not worried about those costs that we can't control. And a lot of that comes down to if you're a department manager. So you are responsible for all of those costs in your department, but you wouldn't necessarily be, and not necessarily, you would absolutely not be responsible for your own salary. That would be part of your boss, your manager's part. So that's where we're going to talk about indirect expenses as well, how we're going to allocate those to departments. We're going to prepare income statements and contribution reports and talk about what those are. And then we have several ratios at the end of the chapter that we're going to discuss and work through how to use. So let's get started. So the first thing we're going to do is jump right into a procedure, and we're going to prepare a responsibility accounting report. And we're only going to look at controllable costs. So it's easier if we divide the company into smaller units, right? Because the CEO is over the whole company, but he can't manage all departments. And so we can break these up in various ways. We can say this is a cost center. So there's cost centers and there's profit centers, right? So cost centers don't make any money. They just cost, right? So if you're thinking about an organization, human resources, they don't generate any profit. They just incur costs, or the marketing department, or the IT department, or housekeeping. All of those types of centers are cost centers. And so we're going to look at what they can control versus what they've been budgeted. So the actual versus budgeted, but we're going to narrow it down to just what they can control. Now, the profit center, they have both income and expenses, right? So then we're looking at specific departments. So if I was talking about my experience at a hospital, it would be the cancer center generated profit. The laboratory department would create profit. X-ray, emergency room, physician offices. So those would be profit centers. And now investment centers is when there is a company that's just investing income, right? They're trying to buy assets that will generate income or make those investments into other companies and financial tools in order to generate a return. So again, if they're controllable, we as a manager can determine or influence those. And so if we're thinking about a department manager, supplies are definitely something that the manager can control, right? Now, something that's uncontrollable, that means you cannot control it, right? And even though you'd like to be able to set your own salary, if you were the manager, it is not in your control. And so you would not be responsible for that amount. So if we kind of look at a hierarchy of how a company's set up, again, we start out with a board of directors. They come together and they are responsible for hiring the president. So they vote in or out a president. And then the president is responsible for hiring and managing. And often, sometimes the board will be working with the president to hire these higher level positions, these different vice presidents. So here, the example is they have a vice president in Europe, a vice president of the USA, and a vice president of Asia. So just kind of expanding on USA, and this probably looks the same in Europe and Asia. So the vice presidents are over the plant managers or the directors. So they're over several different departments usually. And then there's a manager over each department. And so this board of directors ultimately is over all of this, but they can't control any of that, right? What they control is the president, And then so we get down here and we start looking at the manager is only controlling what's in their beverage department. They are not worried about what's in the food department, and they're definitely not worried about what's the responsibility of their manager. So again, pretty logical stuff. So hopefully it's not too difficult. So let's look at the financial statements broken down. You can see this is the vice president, this is the manager, and this is the department manager. So this is a plant manager versus a department manager. So you can see there's controllable cost is all that we're looking at. So the vice president is going to be over the salaries of his plant managers, right? So whatever this guy makes and whatever other plants he's over, he's got his budgeted amount and he's got actual. Depreciation, to me, that's kind of hard. You can't, it is what it is. But you can be responsible for the amount of depreciation that you have, office costs, and then notice how they have like overall costs for the different factories that they oversee. So this is where this plant manager, their total of being over or under is going to tie into the line item here for the vice president. And then they have same thing. There would be another card like this for the Eastern factory. So when we look at the Eastern factory, they have this line that comes right up from the total right here of who they oversee, their manager of beverage department. So they also have a food department and a service department that they're over. So these are controllable costs. They have oversight into the bottom line. So while they're looking at all of the individual things they can control, this guy's looking at the big picture of everything as well. So there's some oversight. All right, let's talk about how we're going to allocate those indirect expenses to the department. So if it's direct, we can trace it, right? It is directly traceable to work in process. They're just easy to identify what costs are direct. And indirect cost means that there are several people that are using the same product or service or whatever it is that incurs a cost. And so it can't be traced to just one department. And so we're going to have to figure out how to allocate that. So like IT department, they're servicing all the departments in the hospital. So how are we going to allocate that cost to them? And you're going to see a lot of concepts in here that are very similar to our activity-based costing chapter. So that's why it's kind of a review. And here it comes. They're saying, hey, it makes sense to allocate supervisor salaries based on number of employees to the department. So if I'm over 4 departments, I have one department has 10 people, another department has 5, and then the last department has 2. Obviously, I'm going to spend more time trying to manage those 10 employees versus the 2. So my salary should be allocated more toward those bigger departments. Rent and utilities, great allocation base would be your square feet. Advertising, percentage of sales could be an avenue. It could be, gosh, I actually think that that's a really good one, percentage of total sales. So I'm not going to elaborate on that one. And then insurance is going to be spread across the value of the insured assets, because obviously the more that we insure, the higher that cost is going to be. So we'll take the total cost that we have to allocate, and then we're going to take it times the percentage used. And in this next slide, you're going to see that. Nope, I lied. It must be the slide after this. So if you have a service department, like 100% of that, because they're a cost center, not a profit center. When you have a service department, they provide service to the rest of the departments. So we have the office, payroll and personnel, purchasing, maintenance. These are all incurring expenses, but do not create a profit. And so different ways that we could allocate it would be the office would be the number of employees or sales in a department, personnel and payroll based on the number of employees, purchasing, the dollars of purchases or the number of purchase orders processed. Maintenance would be on square feet of space occupied. It could be the number of machines in a department. It could be so many things. And so here is the slide where we're saying, all right, we're going to allocate our cleaning service. It's $800 a month, and they clean all three of these departments. And so I know the square footage, and that's how I want to allocate it. So I have 2,400 square feet in jewelry, 600 in repair department, and 1,000 in clothes. And if I add those up, it's 4,000. So I'm just taking the jewelry department, the 2,400 divided by the total, it gives me 60%. 600 divided by the total gives me 15%, and 1,000 divided by 4,000 gives me 25%. So this is how I'm going to allocate the cost. So I take that percentage times the cost, which is 800, and I'm going to allocate 480 to jewelry and 120 to repair, and then $200 to clothing. So when we were talking about service departments, again, they're a cost center. Purchasing doesn't create any kind of profit, so they're only a cost center. And so they have some direct expenses, and they may have some allocated indirect expenses, because the service department is probably using a little bit of IT services as well. So they could accept more expense that are indirect. So that total then kind of gets funneled to the profit centers. Ultimately, the profit centers need to be able to cover all of the expenses, right? We don't want to be generating sales, but not covering all of our costs. But we want to make sure that the appropriate people are managing those costs. So we have two different departments. We have hiking and camping. So we're going to look at each one of those. We're going to look at their sales. We're going to look at their direct expenses. We're going to go ahead and subtract any of their indirect expenses and any of their allocated service department expenses. And that's going to end up to give us our departmental income. So if we accumulate all of the expenses right here, and we spread that across, so we have purchasing, hiking, and camping. Obviously, the purchasing department is not going to have any sales or cost of goods sold. That's just for hiking and camping. We have salaries, and there's the salaries in each of those areas. We have depreciation in those three areas, and then we have other indirect expense that we can't trace to any one of those departments, whether it be service or operating. And so we're talking about rent for the entire building. So all three departments are inside of the building, and advertising can't be traced specifically to a department either. So it's advertising the whole company in various products. So we come up with how to allocate the expenses, the indirect expenses. And again, we do what's called a proration, which is taking, like we did before, the individual item divided by the total. So here's our square feet, that's our total. So the individual item divided by the total tells us 20%, 30%, and 50%. So then we can multiply by that percentage by the cost, the 1,200, and we know how much we're allocating that cost. And so 4,000 in advertising is allocated based on sales. So they're looking at just the sales for these two departments, taking a proration of it. So we have a 60 and 40%. And so we're able to take those percentages times the total to get the allocated cost. So then we can go back to our income statement and put all of our expenses. This is just the expense portion and not the sales portion to make it a full, so it's like a partial income statement here. So we're going to do direct salaries, and then we have depreciation. And so this total is getting split between these three areas. We have indirect expenses, which we're allocating. And then we have our service department. So that 19,400 that they were allocated is going to get split between hiking and camping so that it zeroes this out, because they're really any of your cost centers, all of their costs have to be allocated to a profit center so that we can tell if we're making money or not. And so once it's allocated and it's based on purchase orders, then we have our totals, and that total, these two added together, will equal our total expenses here. So we have our income statement. So we're bringing that portion of the expenses from the other side on over into just the hiking and camping section. So we have their sales, we have their cost of goods sold. We have the salaries, the depreciation, the rent that we've allocated, the advertising that we've allocated, and their share of the purchasing expenses that we've allocated, that 19.4 that we split from that cost center. Tells us our total expenses that match up with the previous screen. And so I can see that hiking has a profit of $24,000, camping is losing $5,000, and together we have a $19,000 income. And so we're going to measure our performance based on what can we control, right? So here they're just showing the gross profit minus the expenses is going to be that department's contribution to the bigger overhead. So the bigger overhead would be like your VP salaries and president salaries and things like that. All of those are indirect, bigger costs. And so they're able to cover those costs, or it'll go straight to, if all those costs are covered, it'll go straight to income. So that's how that works. We're going to go ahead and do some homework problems real quick. And then I'll come back to the slides. So let me bring this over. Okay, so we have the following information is provided for each investment center. So we have cameras, phones, and computers. We have their income and we have their average assets. And actually, nope, I have to continue. Hold on, sorry about that. Okay, so our investment centers are responsible for revenues and costs for the investment and operating assets. So they have two different divisions, the LCD and the phone, and it gives us our income and our average assets. And so if we take our income divided by our assets, so we only buy assets to generate income. We don't just buy assets because it's fun, even though personally people do that all the time, right? They're like, oh, I'd like to have this very large TV for my entertainment pleasure. It creates zero income, but we just want it, right? That's our personal lives. But in businesses, we're not buying assets theoretically, unless we're generating income. I just had it cross my mind like, oh, people buy really ridiculous stuff for their offices sometimes and it gets expensive. So there's that. Anyway, so we're going to take our income and divide it by our average assets to get our return on investment. So if you're ever curious, how do I come up with my average assets? Well, if you have two balance sheets, the end of year one and the end of year two, the end of year one becomes the beginning of year two. So if I take the beginning of year two plus the ending of year two, add them together and divide it by 2, you'll get your average, okay? So in our homework problem, we're going to do our return. So we've just copied the income and the average assets right down here. And so we're just going to take equals our income divided by our average assets. And we're going to turn that into a percentage. And then we're just going to pull that down. So hover over the bottom right until it turns into a black plus sign. Hold your left mouse button down, drag it, and then release the mouse button. And so there are all of our return on investments. So I'm doing a lot better job creating income from my investment in the camera section than I am on the computers. And so they want to know which center performed the best. It was the cameras. They did great. Way to go, cameras. Woo woo. All right. So now we're going to assume a target income of 14%. Well, I think we got to go back to the slides on this. That's okay. Real life, real time learning here, kind of. All right. So our residual income is our income minus our target. It's kind of like what's left over after I've hit my target. And so if my income here is 750,000 and my target is going to be 8% of 2.5 million. So they're going to say 200,000. My residual is going to be 550,000. the actual income for phones was 370. They had a target income of 1.85 million times 8%, which is 148,000. So when we subtract that, we have a residual income of 222. So targeted income, targeted return. I think now we can do this. Oops, sorry about that. Too many screens. All right, we're bringing back the homework. Okay, so we're going to start out by taking our average assets. So we're going to just copy these down. So for cameras, it is going to be this 22,000. For phones, it's going to be the 14.7. And for computers, it's going to be the 18 million. And then we're going to say our target, and they tell us what the target is. It is 14%. So we're just going to put 14 all the way across. And so our targeted income, if we multiply that, equals average assets times our targeted income. So I'm just going to override the formula here. It didn't carry over correctly. So I'm just going to do the same thing, equals the average assets times the targeted return. And again, equals the average assets times the return percentage. All right, so once we know that, we're going to line that up with our income. And so we had income in the camera department was this 5,850,000. In the phones, it was the 2 million. And in the computers, it was the 800,000. And then from that, if we subtract the targeted income, which is the amount from that we just calculated up here, I'm just going to copy it equals in each one and click on the cell above. And now we can subtract these two. So equals our income minus our target gives us residual, gives us a residual loss. 58. 5 million sure does. Seems like that's wrong. Let me make sure I didn't do something wrong. Average. Oh, it is because I just took it times and that's a percentage. So let's go ahead and put a percentage sign. I did this, I think, the last recording. Apologies. So put a percentage sign after we reference that 14%. There we go. Okay, that brings it a little bit better in perspective. I'm like, wow, that's a really big loss. Okay, so we have our income minus our target. And so we have some residual income of 2 million. And so we're going to hit equals this minus this. And so we have no residual income. And here we actually have a loss. All right, so that should do it for questions 1 and 2. Let's take a peek at 3 and 4. Yeah, I think we can do this. So we've talked about responsibility accounting, so let's go ahead and jump into this. Tell me I'm sharing my screen. Okay, good. Let me stop and reshare just because I'm afraid. And I have no idea why I try to sing stuff as I'm talking to myself. I don't know. I apologize that you have to deal with that. But hopefully the benefit is better and more than the cost of listening to me sing stuff here. Okay. Anyway, the whole system's a little jinky. Like normally the screen that I share has all of the Zoom features around it. And so I just kind of freaked out a little bit. All right. So we have Arctica. They manufacture snowmobiles and ATVs, and these products are made in different departments, and each department has its own manager. And each responsibility performance report includes only those costs that the department manager can control. And they're giving you some examples there of those controllable costs. So we have direct materials, direct labor, supplies used, and utilities. And so they want us to prepare a performance report for the snowmobile department. So we're going to start out with a budget for the snowmobile. And so this is the budget for the snowmobile for direct materials. So we're just going to copy that down. Direct labor, again, we're just going to take the number from the budgeted snowmobiles of 10,008. Supplies used. Notice how we jump over that departmental manager salary because they cannot, again, control their own salary. So we're going to control the supplies used, which is 3740. And then the utilities of 400, but they can't necessarily control that rent because it's not like that's something that they can negotiate. Usually at the departmental manager level, that's something that's handled at the higher level. So we have our controllable costs budget. Now we're going to put in our actual. So this section has the actual, and we're looking at snowmobile. So the actual was 19,820. Direct labor was 11,100. Supplies used was 3570. And utilities was 370. So if they're under budget amounts, they want to be indicated by a minus sign. So so we're going to take the actual minus the budgeted. So we did come in under budget. It's less than. And so again, take the actual minus the budget equals actual minus the budget. Oops. Equals actual minus the budget. I hate when it doesn't all format the same. And when I do this, it's going to take away my bolded underline. Okay, put underline, thick bottom border. There we go. All right, so we can take that. We just did a sum of all these. So we can drag that across and it'll sum them all up. So I can see this was the budget and we actually came in over budget by $40. So we're going to do the same thing for the ATV department. So we're going to grab the budgeted controllable costs, which again are direct materials, direct labor, supplies used, and utilities. We're going to add all those up by hitting our sum button. And now we're going to do our actuals, which in the ATV is over here. So direct materials were 29,260, direct labors 21,680, supplies 990, and utilities were 540. And we're going to take the difference. So take the actual minus the budgeted, and we can drag that down. When you do that, it will rewrite that cell formatting. So you'll need to add that thick bottom border if it bugs you. If it doesn't, don't worry about it. Then you can click in the cell and left click and drag it across, and it'll give you your totals. So my actual came in $2,150 more than budget. So that could be a problem. We might need to talk to that departmental manager and really understand why our direct materials came in so much above budget. Okay, we take a peek at number 5 is on transfer. So we need to cover a couple more things in this PowerPoint slide. All right, so if we look at some of the analysis section, that's when we get into percentages and we try to answer bigger questions. So you're going to have some formulas going on in here. So we just learned about our return on investment, and it's going to equal the income divided by the sales times the sales divided by the average assets. And you're like, wait a minute, what I just learned was it was income divided by average assets. And that's true because in basic algebra, these two would cancel each other out. But we're splitting them apart so that you can see how we come up with these numbers. Like if you didn't have all of the pieces, here's how we get it. So we would take our profit margin is our income divided by our sales, and our investment turnover is our sales divided by our average assets. And when we multiply those two together, again, these two wipe each other out. So the formula becomes income divided by average assets will give you your return on investment. And so if we want to find out our profit margin, again, profit margin income for LCD is 750 divided by sales of 9 million tells us I have a profit margin of 8% for LCD. Following the same formula for phone, I have a 5% profit margin. Our investment turnover, again, is taking sales divided by average assets. And so I have 3.75 as the amount of times that I'm able to turn over my assets based on my sales. So the higher the number, the better on that investment turnover. And so it is higher with the phone. Look at me, I'm just showing you in notes instead of full screen. Sorry about that. All right, there's also a thing called a balanced scorecard. And so these are different performance indicators that a lot of companies will use. I know when I worked at BJC, we had these pillars, and this is a lot what it revolved around, because these are the things that make your company successful, or if not, they're the things that can be a detriment to your company. Sorry about that. I'm doing my recording a little earlier in the day, and I'm still on the coffee drip to get my caffeine going. So we have our customer section. So what is our customer satisfaction? Are we getting new customers? Are we delivering our products on time? Are we selling new products or increase in sales? How long is it taking us to fill the orders? How much of our sales are being returned? So these are all very important indicators to make sure that our customer is happy. We also want to look at our internal processes. Are we creating a lot of defects? Like, do I have to recreate the product several times before it goes out? How long does it take me to actually produce that product? Like, how long does it take to cycle through the entire production process? What are my production costs? How many labor hours is it taking per order? How many days have we been accident free? So this is important and is huge, especially in manufacturing. My husband is the safety manager at Veland, and so accident-free days are very important. And a lot of companies will reward employees, but they have to be careful. You don't want to reward employees to the point they are not telling you about the accidents that are occurring. So it's a fine balance there as well. Also, how many warranty claims, because those warranty claims could mean that there's something wrong in our internal processes, creating a product that isn't withstanding some usage, some normal usage. We like to focus on innovation and learning. This is very important. Like, how happy are your employees? If your employees aren't happy, they're going to leave, and you have a lot of expense in that. You have to retrain, there's a learning curve, all kinds of stuff. So if they're happy, they're going to stay. We want to look at our employee turnover and figure out how to bring that down. We want to look at how much we're spending on training. We want to make sure that we're investing in our employees. We like to look at the number of new products we're offering because we want to stay competitive. Are we creating new patents? Are we spending money on research? So this is all about innovation and learning for our investing in our employees and our products, which ultimately will drive our company. And then the fourth pillar is going to be financial. What's our net income? What's our return on investment? How are sales growing? What's our profit margin look like? What's our residual income? How quickly are we turning that inventory over? Because we don't want to be sitting on that inventory because that's money that's not working for us. We just want to invest in it, invest in what we can sell pretty quickly. So that's an idea of what the balanced scorecard is going to look like. So now we're going to just kind of wrap up this chapter and talk about transfer pricing and how we set transfer prices. And so sometimes you have a product that can be given to another department within the same company, but you have a choice like, oh, I could produce more and it could be a component of this other department. And so when you transfer it to another department, you need to at least cover your costs. And sometimes you may end up creating a little bit of profit. But there's always a bottom level. Like, I can't sell this to this other guy, even though he's in our company, for anything less than $30 because that's how much cost I have in it. And you're probably like, well, why would we do that? Why wouldn't we just transfer it? So sometimes the departments are like little companies within the same company. So if you think of Coca-Cola, they have the Coca-Cola bottling company, and then they have where they just create the bottles and then, well, cans now, right? They don't do a whole lot of bottles anymore. And then they have the actual soda manufacturing, right? So they buy the bottles from their own company. And so they're trying to stay in, make it profitable and not drive up the cost too much, right? Because they can't sell it to their other department if it's going to exceed what they can sell the product for when they're finished with it, right? If there's anything that they're going to add. So this picture is saying, hey, we normally sell this, the market price if I buy it from somebody else is $80, okay, that's the cost side, but so obviously you want to make sure that there's a cushion because they want to be able to create a profit. So this screen is just telling us this is our negotiation range. So, how much can I charge? And so if the LCD division, so the person that was on the left side of that chart, if they are producing and selling 100,000 units to people outside of the company, they don't have any extra capacity. So if they're going to sell some of their LCD screens to the phone division, they're going to charge them market price, like what anybody else would pay for it. And so you want them to basically get that full market-based transfer price if they're at capacity. Now, if they're not at capacity, so I have room to make some more, they need to figure out where they're going to negotiate. And so they've decided that they're going to go above $50 because they need to make a little bit of profit, right? We saw that their cost was 30, so they're trying to make some profit. They're not making the full profit that they would from selling it to outside the company, right? They would sell it to other people outside the company for 80, but they're going to cut a deal. And so this is a cost-based transfer pricing, and they have negotiated that price. I'm going to look at number 4 real quick. Actually, I'll come back to number 4. Let's go ahead and get this similar question out of the way, and then we'll wrap it up there. So the trailer division of Baxter Bicycles makes bike trailers that attach to bicycles and can carry children or cargo. The trailers have a market price of $90 each, and each trailer incurs $36 of variable manufacturing costs. The trailer division has capacity for 23,000 trailers per year and has fixed costs of $56,000 per year. Oh, $560,000 per year. Assume the assembly division of Baxter's Bicycles wants to buy 4,300 trailers per year from the trailer division. If the trailer division can sell the trailers it manufactures to outside customers and has no excess capacity, what price should be used to transfer them between divisions? So it's market price, right? If they're at capacity, they're going to charge the market price, which is $90 each. Now, if we assume that they only sell 9,600 units to outside customer and they have excess capacity, the assembly division wants to buy 4,300 trailers per year from the trailer. What is the acceptable range? So we want to at least cover the costs. So we don't want to go anything less than this $36, but we wouldn't charge them more than the market price, which is that 90. All right, so that wraps it up for your homework problems. Let's just finish this chapter out. So we want to look at the number of days in the cash conversion cycle. So the cash conversion cycle looks at how long does it take me to collect what my sales and how long until I have to pay, right? And so there are actually 3 different components to this. We're going to look at the days sales and accounts receivable. So how long does it take me to collect that cash from the sales I sell on account? So we're going to take our accounts receivable net. And if you remember from financial accounting, net is net of any discounts, right? So discounts or returns and allowances. So we have our accounts receivable net, and we divide that by our net sales. And again, net sales less any discounts and returns, and we take it times 365 days. So that's going to give us our days sales and accounts receivable. To that, we're also going to add in our days sales and inventory. So we have purchased this inventory, and this is our cost of goods sold. And so when we divide those two and take it times 365 days, it's going to tell us basically how many days that inventory it takes to sell that inventory. And then we're going to subtract out how long do we take to actually pay, right? We want to collect in a short amount of time, but we want to pay and back in the most time that we can take. So that'll tell us, it'll tell us how quickly we can convert everything into cash. So we don't want to pay it any sooner than we have to, because that's money outstanding. So if we take accounts payable divided by a cost of goods sold times 365, that's going to be days payable and outstanding. So this plus this minus this will tell us our cash conversion cycles. And so here they've done the calculation for the current year and the prior year. Here's all 3 of those numbers, and then they net them together, 1 plus 2 minus 3. So we have 10 days it takes us to convert our activities into cash in the current year versus the prior year, it only took us 8 days. So it's taking us 2 days longer to have cash converted, all of our activities converted to cash, basically. So we would really want to pay attention to that. We don't want to make those days any longer than it needs to be. This last slides talk about joint costs. So when this company buys milk, they buy it raw, and then from there they have all of these different products. So at this point, then we would need to split the costs up, and it could be allocated based on how many they're producing, and a percent of total sales is what they've done here. So they've got 12,000, and again, we're taking the percentage. You're going to see repetitive formulas and approaches in accounting. So we're just taking the portion compared to the total to get the percentage, and then we're allocating the costs. And I think that is, yes, it is it. So thank you for tuning in. I think the only other thing I will be making a recording for a project. I think we have project number 3. So I'll be trying to do that shortly. And again, we will have the next recording will be over chapter 23. After that, we only have one more and you are done with the class. Yay. So you're almost there. Thank you so much for tuning in. I'm glad that you find these helpful. And as always, feel free to reach out to me on my cell phone, 618-946-0325, if you have any questions, comments, or concerns. Bye.